What is, according to our format, what is the first step to calculate EBIT? So earnings before interest and tax, that is 60 lakh into 20%. A company earned net operating income of 80,000. So what is the net operating income? 80,000. Assume that the previous problem, the company increased the debt from 5 lakh to 7 lakh and uses the proceeds to repurchase equity. What is the effect? Hello everybody, I am your Divya Ma'am, Assistant Professor from Department of Commerce and Management, lecturing Vidhyaashram, First Grade College, MYSURU, the Temple of Excellence. It's my honor and privilege to welcome you all for this session 11 on your Unit 1, that is Capital Structure Theory. So in the last class, we have discussed about the capital structure theories, relevance theory, NI approach. We have also discussed problems on NI approach. So kindly go back to the previous class and check out the problems. In today's class, we'll be continuing on the problems of NI approach, and we'll also be discussing the format and the formulas of net operating income approach and the problems based on that. So without wasting much of our time, let's start the class. So problem number 3, again, we'll take up the problems for a better clarity and understanding on your net income approach. So we are solving one more problem, that is your problem 3. Spring Limited issues 12% debt of rupees 30 lakh. Debt is what? 30 lakh. 12% is the interest rate. And Summer Limited issues only equity company. We have two limiteds, two company here, Spring Limited company and the Summer Limited company. Spring Limited issues debenture. They are using in their capital structure debenture, wherein the Summer Company Limited is using only equity as a source of finance. That is 30 lakh. Company earns 20% before interest and tax on their total assets of 60 lakh. So 60 lakh is how what? 60 lakh is your total value. On that, you will need to calculate the percentage of 20%. So 60 lakh into 20% will be the net operating income, that is your EBIT. Next, company assumes a corporate tax of 40% and the capitalization rate is 15%. 15% is 0.15. For all the equity company, calculate the value of both the case using NI approach. So we are doing for Spring Limited as well as Summer Limited. So what is the format? Particulars, amount for Spring Limited and for the Summer Limited. So this is Spring Limited, this is Summer Limited. What is, according to our format, what is the first step to calculate EBIT? So earnings before interest and tax, that is 60 lakh into 20%. 60 lakh into 20%, it is 12 lakh. So 12 lakh is the earnings before interest and tax. Next, less interest. Only Spring Limited is using what? The debenture, that is you need to pay the interest for Spring Limited. Summer Limited is purely the equity shares. So what is the interest rate? 30 lakh into 12%. It is 3,60,000. So 12 lakh minus 3,60,000, it is 8,40,000. What is this? Earnings before tax. With this, we all need to divide the equity capitalization rate, that is 15%, 0.15, 0.15, 8,40,000 divided by 0.15, it is 56 lakh, and 12 lakh divided by 0.15, it is 80 lakh. So what is this? Market value of equity. To this we have to add what? Market value of debt. Add market value of debt only for the Spring Limited, since the company is using the debenture. What is the debt value? 30 lakhs. 56 lakh plus 30 lakhs, it is 86 lakh. 86 lakh and 80 lakh is what is the value of the firm. So let's substitute in the formula. So calculation of overall cost of capital for the Spring Limited. What is the formula? EBIT divided by value of firm into 100. What is earnings before interest and tax? 12 lakh. Next, 86 lakh into 100. Similarly, we have to do it for the Summer Limited. 12 lakh is the EBIT, and the next is value of firm is how much? Value of firm is 80 lakh into 100. Now let us calculate it. 12 lakh divided by 86 lakh into 100, it is 13.95%. So similarly, we have to do it for the Summer Limited. Next, problem number 4. Similarly, to make you all better understanding, only the changes will be there in the debenture and the equity capital structure changes we can see, and we can see the changes in the overall cost of capital. Next, a company earned net operating income of 80,000. So what is the net operating income? 80,000, and it has 2 lakh 8% debt. The equity capitalization rate of the company is 10%. Cost of equity is how much? 10%. Calculate the value of the firm and the overall capitalization rate according to NI approach, and calculate the value of the firm if the debt is increased by 3 lakh and 1 lakh. So that has increased by 3 lakh and 1 lakh. So 3 calculation you all have to do here. See here, a company earned net operating income is 80,000, 80,000, 80,000. Since 3 calculation has to be done, because one is 2 lakh 8% debt is used. The debt has been increased by 3 lakh and the debt has been decreased by 1 lakh. So 3 calculation has to be done, and you all have to solve the problem. So this is your homework problem. So you all have to do it and check out the answer. Similarly, everything is similar as the EBIT is given. Deduct the interest. 2 lakh interest is 8%, 3 lakh interest is 8%, 1 lakh on 8%. You'll get the interest. For all the 3 calculation, you'll have to get the EBT divided by overall, divided by equity capitalization rate. Then you get your market value of equity. If you add the debt value, you'll get your market value of firm. So EBIT divided by market value of firm into 100. If you all do it, you'll get the overall cost of capital. Next, formula for NOI approach. So EBIT, net operating income, divided by overall capitalization rate, you will get your market value of firm. If you deduct the market value of debt, you will get your market value of equity. And in this, they will ask you to calculate the equity capitalization rate. So EBIT minus interest divided by market value of equity into 100. So this is the verification formula. Let's solve the problem. A company is having EBIT of 1 lakh, debt borrowed at 10% of rupees 5 lakh, and the overall capitalization rate is 12.5%. What would be the value of the firm and the equity capitalization rate? So, my dear students, in your net income approach, they'll ask you all to calculate the overall capitalization rate, wherein in net operating income approach, they'll ask you all to calculate the equity capitalization rate. Conditions we have: Assume that the previous problem, the company increased the debt from 5 lakh to 7 lakh and uses the proceeds to repurchase equity. What is the effect? So let's solve the problem. Particulars and amount. What is the format? EBIT, earnings before interest and tax. Two calculation you all have to do, wherein debt is 5 lakh and the other debt is 7 lakh. So next, divide by, what is EBIT? 1 lakh, 1 lakh. Divided by overall capitalization rate that is given in the question, 12.5%, it will be 0.125. It is 0.125. So 1 lakh divided by 0.125, it is 8 lakh and 8 lakh. Next we have is value of firm. What is this? Value of firm. Next to this, if we deduct the market value of debt, what is given in the question? Market value of debt is 5 lakh and 7 lakh. 3 lakh and 1 lakh. What is this? Market value of equity. So for this, what we'll need to do it? We have to apply the formula. Equity capitalization rate is equal to EBIT minus interest divided by market value of equity into 100. So what is EBIT? 1 lakh is EBIT minus interest. So 5 lakh on that, 10% interest. It is 50,000. So what is the equity value that we have got? Market value of equity 3 lakh. So 1 lakh minus 50,000 minus, it is 50,000. So 50,000 divided by 3 lakh into 100, it is 16.67%. Okay. Similarly, we have to do it for the second case, wherein the calculation changes. So 7 lakh into 10%, it is 70,000 minus 70,000 divided by, what is the market value of equity? Market value of equity is 1 lakh. So 1 lakh minus 70,000, that is 30,000 divided by 1 lakh into 100, it is 30%. So this is the verification formula. You can check out the answer. So what we have done, whether it is correct or what, if you apply the verification formula, we can easily get to know. So how to apply verification formula? This overall cost of rate is given in the question itself. So what is it? 12.5%. So this values, if you substitute, it should be equal to 12.5%. So then only the problem which you have done is correct. So cost of debt. What is cost of debt? 5 lakh and 7 lakh. So 5 lakh you have to write here, 5 lakh. What is cost of debt? Is nothing but the interest. What is cost of debt? Debt is nothing but the interest. So 10% is the interest you all have to write. So with that, if you have to put the value of debenture 5 lakh, value of firm, that is how much? 8 lakh, plus if you do it, the cost of equity, we have calculated now the cost of equity 16.67%. If into equity, what is equity value is 3 lakh divided by value of firm. If you substitute it, then you will get the answer. So it should be equal to 12.5%. So that is a calculation that you all have to do on your part, so that for your better understanding on the problem. So that's it, my dear students. By this, the first unit, that is your cost of capital as well as your capital structure theory, is over, so that you have a better clarity from the first unit itself. In your examination, you can expect that chapter itself for 25 to 30 marks in the first unit itself. So it is very important. The sessions, the 11 sessions, was very important for you all. So kindly understand all the problems and go to your examination so that you can score better marks. So smile is the biggest jewel, people. Keep smiling. Thank you.